This is Mike Swanson. You're listening to the Wall Street Radio Podcast. Often I do these podcasts with a special guest, but today it's just me. And for two reasons. First of all, I like to do YouTube videos, and then when I'm done making the video, usually I'm walking around, I'll put some charts into it about the stock market, but it's too cold outside for me to want to walk around, so I'm doing an audio recording inside my house. And second reason is I'm taking advantage of that to do an experiment. I'm going to send this audio recording off to a company when it's complete, and I'm going to see if they can make a text transcript of it fast enough that I'll be able to get it on the website tomorrow as a blog post. We'll see if they can accomplish that mission. But when it comes to the stock market, there's a couple points I want to make with you today. First of all, the trend is obvious, and that is that the stock market's not going to crash, it's not going to soar. Neither one of those things is going to happen in the short term. Instead, it's a chop. It's a chop situation. Stock market dumped with the Dow down 450 points on Monday. There was some bad news associated with that drop, but on Tuesday we bounced. Thursday morning, a nasty opening, but the market bounced again. So it hasn't been able to collapse to the downside, but it's not in a position to soar either. And yes, there's been some bad news, but that bad news has not been enough to derail the stock market because we're in a chop situation, not a collapse situation, but a chop. That's the defining trend. And yes, there has been bad news. Let's talk about that. First of all, the coronavirus. Look, coming into this week, I was hopeful that the situation would kind of die out, that cases would not spread to the United States, but now we got a couple, but it's not a big deal. But what is a big deal is that on Tuesday, the World Health Organization made an announcement. They said they looked at the situation and it wasn't that bad. They said it was not a global health crisis. But then on Thursday, before the stock market had opened up, they said, it is a global health crisis. That's bad news. It means that it's going to be a bigger impact everywhere over the world with the economies than we were expecting a week ago. Just the way it is. Doesn't mean you should be scared. Doesn't mean you should be afraid to go outside your house or afraid to travel, afraid to live your life. But it means that there is going to be an adverse economic impact in China for a longer time than we and anyone else. And imagine, there's cities in China in complete lockdown. That situation's now is going to last probably through the spring. That's typically how long it takes for a virus of this sort to simply die out. So that kind of impacted the markets this week in a negative way. But a more important news item hit the United States when it comes to the economy, and that is that Thursday morning, fourth quarter GDP numbers were released. They showed that last year in the fourth quarter, GDP growth was at 2.1%. It was growth, but slower than expected. But even worse, they have figured out that for 2019, GDP growth is clocked in for 2.3% for the year. That's a bad number because we were promised 3% growth. We were promised that tax cuts and mega stimulus, which is what we're getting from the government. We had a massive boost in defense spending to provide jobs and money for defense contracting companies that would trickle into the rest of the economy, helping to create $1 trillion deficit. That, with the tax cuts, would create 3% economic growth. Did not happen. So, and the details also show that in aggregate, corporate investment spending is negative. So we're not in a boom situation when it comes to the U.S. economy. And the growth is not as good as we thought it would be. When stocks report growth not as good as can be, they can often sell off. We've seen that this week in some individual stocks. We saw that with Facebook. Facebook dumped on Thursday over 5% because they announced that costs were higher than expected and revenue growth was less than expected. Bad news sent the stock tumbling. Wasn't the only one. UPS also got hit for a 6% drop Thursday because of all these problems. The global economic threat of the coronavirus slowing things down hits UPS harder than it does something like Facebook even, or Netflix, or most companies for that matter, because it's a global company. But they also announced that revenue was already less than expected, so the stock got hit very hard. That's what happens when stocks don't meet expectations. Often they dump. However, for the bad GDP numbers, for the worse news around the coronavirus than it seemed to be, in the end, the stock market is not dumping off all this. That's because the trend of the stock market is chop. Why is the trend of the stock market chop? That's the question to ask. The question to ask yourself is not, oh, I turned on CNBC and the stock market's down, the Dow's down 400 points. Is this the start of the crash? Oh my God, they're talking about coronavirus. Oh my God, we're talking about something else that's bad. No, you have to put all the moves in the market on a daily basis, hourly basis, a weekly basis, in context with what the market has done up to now. And that tells you what the real trend is, and that helps you make sense of the moves going on. What is happening? Well, obviously, going into the end of last year, the stock market went up. It went up huge. It broke out towards the end of October and almost barely went down in any given single day. Every single week was an up week. It came into this year with a very overbought condition. When something hits an overbought condition, as the stock market was coming into the beginning of this year, one or two things can happen. Either you can get a continuation in which things become extremely unsustainable and set the stage up for a collapse or a huge drop. That's what happened in January 2018. That's not what happened here. Instead, the stock market did what the other thing it can do, and that is the momentum can stall, and you can then get a consolidation, a dip, a correction that can play out for a couple weeks. That's what we're in, and it's probably going to continue into the next month. So that's what's going on with the stock market, and in a certain sense, you could tell yourself not much is happening with the S&P 500 right now, or the Dow chopping up and down, hard to trade, a situation like that. But there's better things to trade then. And there's some individual stocks that move in a sustainable manner, and when individual stocks, the right ones, go up, they go up more than the market averages do anyway. You also have things that are kind of washing out on this drop that are reaching a much more oversold level than the stock market has. The S&P 500 is really not oversold. It's barely even dropped off the high. But some things have come down. The energy complex is something that I think is enticing for the next couple of weeks. Let's let it build a base, and then it can turn up. Other commodities are in that situation. And of course, we got gold and silver, which are now acting once again stronger than the U.S. stock market, because any signs of weakness creates a rotation into gold and silver, helps mining stocks go up. We saw that last year. We're going to see it this year. We're going to see it in the years to come, because that's where we are in the cycle. And that's the most, I think, easiest way to make money is pick your spots in the right mining stocks, big caps, small caps, and in between. That's what I'm excited about. But there's a lot of stuff going on, and even when the markets chop, down days create oversold conditions in select sectors that can be taken advantage of, and I think we're going to see some bases built in that context over the next couple weeks. So those are my thoughts for today. Let's see if they can make a transcript for me to upload onto the website, and I'll talk with you later.